Good afternoon, everyone. How are you all?
Good afternoon, sir. How are you, sir?
I'm okay, sir. Thank you. Good afternoon. Good afternoon, sir. So let's start this session. Before starting the new issue or new topic, I just want to ask you: do you have any problem, any query from our previous sessions? Okay.
No, sir.
All right. That's good. Looks okay. But if any query, any problem raises in your mind, feel free to ask me. You can email me. I'll try to respond to you as well, or you can ask me in our discussion sessions. So in our last session, you are supposed to solve a problem that was assigned to you as your practice purpose and homework purpose. Have you done it?
Yes, sir.
Cool. So let's cross-check it with my solution. And if you have any query, any confusion, please let me know so that we can discuss on that and clarify our confusions. So the problem that was given regarding that was given to you, that is P12A from your book. So let's move to that one. This was the problem. P12A. So according to that problem, the initially they mentioned that they have started their business on July 1 and July 31st. The balances of few accounts, cash, accounts receivable, supplies, equipment, accounts payable, and owner's capital are given to us. Then they mentioned that during August, the following transaction has been incurred. And whenever we will start our transaction analysis part, if it is a continuous business, that means they have started their activities on July, and when they started their activities again in August, do you think that there will be some balance of previous month's activities? August 1, they will start with the balance that was at the end of the previous month, isn't it? Yeah. So the balances of the previous month, on that means on July 31st, has been given to us. Initially, we have to transfer those information to our tabular analysis part. So that's why at the very beginning we just mentioned how much balance was for cash, accounts receivable, supplies, equipment, accounts payable, and owner's equity. This is been recorded as a beginning balance. Now I'll discuss it later on. I'll discuss it later on. Just wait. Now, if you looked at the transactions that has been given to us, firstly they mentioned collected 1200 of accounts receivable. That means they had accounts receivable of 1500 at the beginning. Out of that, they have collected 1200. So I that's how I have made the effect into the equation. They are going to receive cash, so cash will be increased by 1200, and accounts receivable will be reduced by 1200. Do you agree with me?
Yes, sir.
Yes, sir.
Yep. Sorry, sir.
So, like, why should I write 12 in the second column?
Cycle column. Can you please repeat?
I mean, sir, why should I write 1200 minus?
Because whenever you receive cash increase, and on the other hand your receivable reduced. Okay, or in other sense, if you looked at this one, if I considered that is a transaction, if you can remember what we are supposed to do, we need to find out activities, accounts, and increase or decrease. This is the analysis part. Can you help me? Collected 1200 of accounts receivable. What are the accounts will be affected here?
Sir, cash and account receivable.
Cash and
Account
accounts
receivable.
receivables. So cash is what types of account?
Sir, asset. Both are assets.
Assets. This one is also assets. Your cash is, you are receiving cash, so your cash will be
Increase.
increased. What is the source of receiving cash? From where you have received the cash? From the receivable holders. That is from this accounts receivable. That's why your receivable amount will be decreased. We are just transferring this analysis here. We have received the cash, that's why cash increase. Our accounts receivable decrease, that's why 1200 minus. Okay. Confusion আছে আর? Do you have any more confusion?
No, sir.
Okay, cool. Number 2. In number 2, they mentioned that paid 2800 of cash of accounts payable, like the previous one. Paid 2800 cash, so cash reduced for the accounts payable. That means someone is supposed to receive money from you. That's why accounts payable arises. Before it was 4200. Out of 4200, now you are paying 2800. So your liability will be reduced. That's why paid the due amount. Number 3, recognized revenue of 7500, of which 4000 has received cash and remaining amount will be received in September. Can you help me? What are the accounts are related with that?
Sir, cash and service revenue.
Cash
Revenue.
and service revenue. Okay. How much services was provided?
7,000.
7000. So you mentioned that cash.
Sir, another account is accounts receivable.
Yeah,
Accounts receivable.
exactly. Accounts receivable, because you haven't received the full amount as a cash. So another account will be accounts receivable. So cash, assets, service revenue, revenue, accounts receivable is a assets. Cash increase, revenue increase, asset increase as well. How much should be the amount? You have received 4000 cash. Sales was 7000. Is it 7000? 7005. 7500. Thank you, sir. And remaining amount will be received 3500 later on. So this is the things. By the analysis we have found these things. Now we are applying it to our equation. So cash has been reduced by 4000. That's why if you looked at here, cash increased by 4000. Accounts receivable increased by 3500. Accounts receivable 3500. There is no revenue account, but revenue has a relationship with the owner's equity. And if revenue increase, owner's equity will be increased 7500. Is it okay?
Okay, sir.
Yeah. And I have explained it as earned revenue. You can write it down: revenue earned and receive cash and due with some amounts are due. But if it is clear, that's okay. Number 4, purchase additional equipment 2000, paying 400 in cash. Again, they have purchased equipment, so their equipment increased, but they did not pay the full amount. They paid a partial amount, 400. So cash will be reduced. And what about the remaining one?
Accounts payable.
Accounts payable. Excellent. Accounts payable. So cash reduced by $200 equipment increased by 4,000, and your liability regarding accounts payable is increasing by $3,800. We have purchased equipment. Paid salaries, rent, and advertising expense. There are three transactions or three activities, but they have written all together. So we can think individually. It is better to think individually and apply it to the equation. So paid salary is 2,800, salaries and cash. Paid rent 900, cash and rent. Paid advertisement 400, cash and advertising. So these are the accounts. So salaries, rent, advertising, all are expenses. In the equation, there is no expense account, but it has a relationship with capital. So we can write it down. Cash for salaries, cash reduced 2,800, equity will be reduced by 2,800. For rent, cash will be reduced by 900, equity will be reduced by 900. For
Sir,
advertisement, yes, sir.
sir, এখানে স্যার অগস্টের স্যার উল্লেখ মেনশন করা আছে স্যার এটা স্যার অগস্টে কোনো হিসাব আসবে স্যার
We are in the month of August or some other month. Which month we are running now?
ডিসেম্বর সরি
We are now in August. So it's a current month, friend. So current month payment is an expense for the organization. Okay. Okay. So all are expenses, and for the advertisement they paid 400. So cash reduced by 400, and advertising expense which will reduce the owner's equity by 400. So that's how it will affect paid salaries, paid rent, paid advertisement. Number 6, withdraw 700 in cash for personal use. Can you help me?
Owner's equity.
Owner's equity in the name of drawings. Okay.
Yes, sir.
So cash will be reduced and drawings increase. That's why owner's equity will be reduced. So cash reduced, owner's equity reduced, withdraw by owner, $700. Receipt 2,000 cash from Standard Federal Bank. Money borrowed on a notes payable. That means this organization have taken a loan from the bank of $2,000, but they issued a notes payable. So we have found a new terminology. One of your friends already asked me, what does the notes payable means? So we found a new terminology that is called notes payable. We are familiar with the terminology which is known as accounts payable. Now we need to know what's the difference between notes payable and accounts payable. Say you purchased an equipment of $20,000, for example, on account. What are the accounts will be related with that if it is a transaction?
Sorry, equipment,
Equipment and
assets.
accounts payable. Yeah, assets and liability. The same thing, purchased an equipment of 20,000 on account, but and a written assurance had been given. That means after purchasing this equipment in a stamp, you have given a written assurance to the seller that you are going to pay this amount of money after this period of time, maybe for 3 months, after 3 months, 2 months, 6 months, 1 year, whatever it is, after a specific duration. In that case, if a written assurance has been given, it is known as notes payable. Equipment and notes payable. These two accounts will be affected. That means what's the difference between notes payable and accounts payable? When you buy something on account, in general, it will be considered as an accounts payable. If you buy something on account and if you provide any written guarantee, written assurance, then this written guarantee or written assurance will be known as notes payable. Have you got the basic difference between these two? Sometimes it's also known as bills payable.
payable
So
are
it's not clear.
related with
Can you give
bank.
a
Sorry, sir, one by one, please.
Is both payable are related with the bank or
It can be related with the bank or it can be related with any other party. Sorry. That means some one of your friends wants another explanation for that. So, for example, when you buy something, sometimes a written assurance will be a written guarantee can be asked from the seller. That means he may or may not rely on you, or if you have notes payable, there are some other advantages as well. So that's why they may ask you to issue a notes payable, issue a notes payable on behalf of them. Say in the notes payable, what is been mentioned in a stamp, you will mention that you have purchased these things from them, and this amount will be paid to that party after a specific time period. That will be known as a notes payable. If written assurance has been given, that will be considered as a notes payable. If no written assurance has been given, that will be known as an accounts payable.
so cannot payable become irrecoverable debt?
If they failed to pay the irrecoverable, yep, it can be. It can be.
But sir, if our buyer gives us a note as
Hmm.
a kind of assurance, so
Hmm.
it can't become a bad debt. We can file a legal case on
You can, if there is a different issue, you can file a legal case, and if that organization doesn't have any specific asset or any asset, in that case it will be debt. Or if they have that amount of asset on their hand, after submit a legal case against them, you can grab it, then it will not be a bad debt for you. It depends on some other circumstances. But the basic difference is that we'll explain this in another chapter, how the bad debts can arise in an organization and what does the bad debt means. But there are many of your friends are newly doing accounting, so I am emphasizing on the very basic thing to identify the different terminologies only. So
Sir,
yeah, sir.
sir, I have a question. That is the money received of that equipment should be considered as written assurance.
If money receipt means,
Money receipt of the
no, no, no,
bought
no, no,
equipment.
no, 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 no. It's money receipt will not be considered as a written assurance. There will be specific stamp. You have to sign it on a stamp. You have to
And
sign. Yeah,
again with mortgage, is that the same thing?
it's almost the same thing. Yes, mortgage means that you are giving your some assets as a collateral to them, and there is a written guarantee to them that you are going to pay this amount and you will take back that asset after a certain period of time. You can consider it as a written assurance. Yep. Say, for example, you bought something. After buying something, or you bought something on account, that will be the accounts payable. But after purchasing these things on account, if you give any written assurance on a stamp that after a certain period of time you are going to pay this amount to that party, that will be known as a notes payable. That means if any written assurance or written guarantee has been given, this one, a written assurance or written guarantee has been given, then it will be considered as a notes payable. Otherwise, it's a accounts payable. Okay. And there are some benefits of having notes payable. Sometimes interest can be charged on the notes payable amount.
Sir,
Yes, sir.
note payable is only applicable in bank, right?
Not only applicable in the bank, for any transactions, any trade transactions, note can be note payable can be applied.
Oh, okay.
And there are some benefits of having notes payable. One of the benefits is that sometimes this amount it can be considered as a loan, and on the loan they can charge interest. Say for this example, bank can charge interest on the loan amount or borrowed amount given to that party. Another advantage is that these notes payable documents can transferable, is a transferable. Say for example, I have purchased an equipment from you with a $20,000, and I have given a written assurance to you that I'm going to pay this $20,000 after 3 months. Okay. Now, by this time, you may need money. And in that case, what can you do? You can sell this notes payable to a third party, and that third party will collect money from me after that specific time period. So this is the benefits of having the notes payable. That means how are you going to sell it? Maybe at a discounted price you are going to sell it. So this is the having benefits of having the notes payable, and that's why it's a very common thing. The in the this whenever any transactions been incurred on account, a notes payable or written guarantee is being issued. So that's the difference between.
After paying the notes payable, do we write it in the notes payable column, like the amount paid?
Yeah, yeah. Whenever, so that's why we now know that notes payable and accounts payable are not the same thing. This is why whenever they mention that they have borrowed money by issuing a notes payable, one account that this organization have received cash, so cash account has been increased, and we have to create sorry sir, we have to create a separate account regarding notes payable. That's why this notes payable account has been written here with $2,000.
And it's a liability.
It's a liability, definitely. Accounts payable is a liability, notes payable is also a liability. So for this transaction, borrowed money from bank by issuing a notes payable, cash increase and notes payable increase. What if they just mention received 2,000 cash from bank or borrowed money from this bank $2,000? If they don't specify notes payable, in that case, what to do?
Sir, accounts payable.
It's better to write down a loan, because whenever you are receiving you are borrowing money from the bank, it is not considered as an accounts payable. Accounts payable is being considered when you are purchasing something. If you borrowed money from the loan or borrowed money from other places, it's better to write it down as a loan. Okay. So if they just mention they borrowed this amount of money from the bank, instead of, in that case we have mentioned notes payable. Instead of notes payable, we will just write down loan account. Loan is also a liability for the organization. Last one, incurred utilities expense for the on account $270. So one is in utilities expense, another one is that it is not been paid in cash on account, so accounts payable. So accounts payable increase, and because of the utility expense, owner's equity reduces. So this is how the transactions are going to be affected into the accounting equation. Is that okay, or any query?
Sir, in number 4, shouldn't it be minus 400 instead of minus 200 cash?
Oh, number 4, let me check. I made a mistake. Oh, it should be 400. Yeah, it's my mistake. Yeah, it should be 400. Then it should be 3600. 600. Thank you so much, sir. Yeah, it's my mistake. Thank you. Any other query?
Sir, if we take a loan, like, should we make another column for that?
Yeah. Whenever any new account will be arises, we have to make another columns for that.
And it should be in the liability.
If it is belongs to a liability, then it should be a part of the liability. If it is belongs to an asset, it should be a part of the asset. Say for example, it's a very good one you have raised. Say rent paid for September. So instead of August, if they mention rent paid for September, what to do? We are in August. Rent for
Rent debit, so rent due credit. Oh, sure.
September. One is cash you paid. Another one,
So we put it on advance, right?
advance rent. It is an, it should be recorded in advance or prepaid. We'll discuss it. Prepaid rent. Cash is an asset. Prepaid rent or rent paid in advance
should be an asset.
It's an asset.
asset.
Exactly, it's an asset as well. And do we have that rent account here? Prepaid rent account here? We do not have it. So if the scenario is like that, what we have to do? We have to create another account regarding prepaid rent and have to include here. Got it?
So that time cash will decrease and prepaid rent
Rent
will
will increase. Exactly. Cash will decrease, prepaid rent will be increased. But if any account is not there, we need to create it. Is it okay?
Okay, so
Cool. So that's how we'll make the tabular analysis. Now, after preparing the tabular analysis, you may ask for preparing the financial statement. Yes, sir. You purchased 4,000 of equipment. Out of 4,000, you have paid $400. Oh, sorry. It should be 2,000. Thank you so much. It was my mistakes or typo. Then 1,600. Is it okay now? I think it's okay now. Oh, yeah. You have purchased an equipment of 2,000. Out of 2,400 paid in cash, and remaining 1,600 will be paid later on. Thank you so much, sir. Thank you for addressing this one. Yeah. So after preparing the tabular analysis, you may ask to prepare the financial statement. Can you remember what are the components of the financial statements?
Assets.
Mm, asset liability expenses are a part of any one of the component. But what are the components of the
Income
finance?
statement, balance sheet,
Income
owner's
statements.
equity,
Yeah,
cash flow statement. Yeah.
exactly. Income statement, owner's equity statement, balance sheet, and cash flow statement. These are the four mandatory statements you need to prepare to complete the financial statement. And after preparing the tabular analysis, you may ask to prepare the financial statement, and from that financial statement, we can prepare first three only. So now let us see how can we prepare income statement, owner's equity statement, and balance sheet from the information given into the tabular analysis. Whenever we want to prepare this statement, we definitely have to follow some format. And based on that format, we need to prepare or complete the financial statement, the income statement. The format of the income statement should be, initially we have to mention the name of the company. Say for example, Sony Azaret is the name of the company according to this problem. So we'll mention Sony Azaret's income statement. Then we'll mention for the something ended, then the date. According to this example, the last date of this month is August 31st. For the something ended August 31st, 2020. So the information is given here. Is it for a month, for 6 months, 3 months, or a year? What do you think?
sir, a month.
For a month. For a month. That's why we'll mention for the month ended. If the informations are given for a year, we'll mention for the year ended. If the information are given for 6 months, we'll mention for the 6 month ended. If the information are given for 3 months, we'll mention for the 3 month ended or quarter ended, and the last date of the month when it has been ended. According to this example, we are handling the August information, and the last date of August is 31st August. That's why we have mentioned August 31st, 2020. That's how income statement will be prepared. And in an income statement, what we show in the income statement, revenues and expenses. All the revenues and expenses will be shown here, and by comparing the revenue and expense, what we can determine net profit, in the bracket we will write down loss. It will be determined. So this is the format of the income statement. These are the headings that show the headings of the income statement need to be written down, and here we are going to show the revenue and expenses to identify the profit or loss of the organization. After preparing the income statement, then we need to prepare owner security statement. The headings is almost same. Sonia Jarrett's owner security statement, and this should be same for the month ended. And can you remember in the owner security statement what is our objective to prepare the owner security statement? What is the objectives of prepare owner security statement?
To know how much the owner invested and how much the owner owes from the company.
Exactly.
Helps on the balance sheet.
It helps to prepare the balance sheet exactly. And the basic objective, if you know whatever we have discussed earlier, that we try to know the claim of the owners and how it is changing. There will be some beginning investment from the owner, then from the activities of the organization, the owner's claim will be changes over the time, and at the end how much claim is. So that's the things we try to identify, and the format will be like that: initial capital, that is the beginning capital basically. According to this example, it starts on August 1. So how much it was on August 1? Sometimes we can see that there are some additional investment. So if there is any additional investment by the owners, that will be increase their claim. And we have seen that organizations may earn some net profit or loss. Their net profit or loss will be adjusted here. And if there is any drawings, we need to deduct it. So this is how we can determine what is the claim of the owners to find out the owner's equity at the end. According to this example, August 31st, 2020. That's how a owner's equity statement will be prepared. And finally, we'll prepare the balance. Finally, we'll prepare the balance sheet. In the balance sheet, again, we'll start with the name of the company. Then we'll write down balance sheet. And after that, there will be no for the month end date or something like that. Only the specific date will be applied. What are the reasons for that? We'll explain it. The balance sheet is prepared for the last day of the organization or the accounting period. It has not been prepared for the whole period. It has been prepared for a specific date. Can you remember what are the information shown into the balance sheet?
Current asset,
All the assets,
all the asset,
all the assets, all the liabilities, and all the owner's equity. Total assets, total liabilities, and owner's equity. These three things will be shown, or the relationship of asset, liability, and owner's equity will be shown into the balance sheet. So these are the things. This is how we can prepare our income statement. These are the formats: income statement, owner's equity statement, and balance sheet. Now let's see how can we prepare these three components of the financial statement from the information that we have at this moment on our hand. So this is the transaction analysis we have done so far. At first, we want to prepare the income statement. To prepare the income statement, what information we need? We need the revenue and expenses. Now, from these informations, we need to find out what are the revenues and expenses here. We can see that we have made an explanation column in our previous session that we have suggested you to add this explanation column into the tabular analysis. Some of your friends have asked me what is the reasons for that. We will now see what's the benefits of using explanation column here for preparing the financial statement part. So from this explanation, we'll try to find out where there is a revenue or expenses are that affects to the accounting equation. So for example, the first one is related to the beginning balance. Do you think that there is any revenue or expenses? In the first row, we have mentioned the beginning balance of cash, receivable, supplies, equipment, accounts payable, notes payable, and owner's equity. Is there any revenue or expense?
No, sir.
No.
There is
No, sir.
There is
there is
no
no new revenue or expenses.
no new or no old revenue or expenses as well, because cash, receivable, supplies, equipment is a part of asset. Accounts payable, notes payable is a part of liability, and capital is a part of the owner's equity. So there is no revenue, no expenses. Collect the due amount. Is there any revenue or expense?
No, sir.
No, because by collecting revenue, collect the due amount, which two accounts are affected? Cash and accounts receivable. Both are assets. There is no revenue or expenses. Paid the due amount?
No, sir.
No. Paid the due amount, two accounts are affected: accounts payable and cash. Cash is an asset, accounts payable is a liability. So there is no revenue or expenses. Earned revenue?
Yes, sir.
Yes, sir.
Yes, sir.
So how much the revenue is?
7,500.
7,500. Excellent. So there is a revenue that affect the owner's equity, 7,500. Purchased equipment,
It's an expense.
is it an expense?
Oh,
So
sorry, asset.
it's an
So
asset,
that is the
exactly.
current.
It's an asset, current asset of the whatever types of asset we'll discuss later on. So purchased equipment is a part of the asset. You can see that equipment increase, asset increase, cash reduced, asset reduced, and liability. That these three accounts were affected. There is no expense, no revenues. Salary
Yes, sir.
is an expense. Rent,
Expense.
expense. Advertisement,
Expense.
expense. So we identified these three accounts are expense for the organization. Then withdraw by owner,
Drawing, sir. Yes, sir.
drawings.
Drawing.
It's a drawings.
Drawing.
Is it a part
Yes,
of
sir.
is it a part of revenue expense?
I don't think so, sir.
It's not a part of expense or revenue. It's a separate account in the name of drawings. Borrowed money from the bank?
No, sir.
No. Utility expense?
Yes, sir.
Expense.
Expense, yeah, it's already mentioned. So this is how, and this is the ending balance. So this is how we find out what are the revenues and expenses related with these transactions. Now we are going to transfer these accounts and respective balances to our income statement. So first one, revenue. Sorry, sir. It is the service revenue, for example. 7,500. Then expenses are salaries, rent, Advertising. Can you help me? What are the amounts? How much the salaries were?
Sir, scroll up a little bit. We'll,
Then I can do it. 2800, 900, 400. Probably 270 was the this one. So you can find out the total expenses here. So now we can see 7500 was the total revenue, 4100 was the total expenses. Now revenue is higher than the expenses, and the difference between these two is net profit or loss. So what is it? It is a profit for the organization.
sir,
I
I
think
think,
that 4,370.
yes, you
Probably.
didn't add the utility bill.
Oh, thank you for addressing. Yep, I didn't get the utility one. Thank you. So total expenses is 4,370 and net profit or loss here we found 3,130. So revenue is higher than the expenses, so it's basically a profit for the organization. That's how we can prepare the income statement. Sometimes we can also see that the revenue can be 3130 or total expenses can be 7500 for any other cases. Can it be happened?
Yes,
Yes, it can be. That means expense can be higher than the revenues. In that case, the results will be
loss.
3130 negative. That will be considered as a loss. That's why we have mentioned net profit in the bracket of loss. That means anything within the bracket or negative sign that will indicate the loss for the organization, and anything within the positive sign that will indicate you the profit for the organization. So this is why I am suggesting you to follow the same format: revenue, expense, and net profit bracket loss. And from the results we will find out whether it's the loss or the profit. If the result shows negative, it will indicate loss. If result shows the positive, that it will indicate the profit. This is why it is better to follow the same format for throughout of your life to handle the accounting activities. Is that okay? Have you got it?
Yes, sir.
Yeah.
So this is the income statement for August, from August 1st to 31st August, right?
Yeah, August 1st to August 31st. That's why we mentioned the 30 month ended. Okay.
So if the year ended, would be right December 31st.
Then we need to see when the year is going to be ended. If it start on January 1, then January 1 to 31st December, then 31st December. You can see some organization is starting their activities on June, July, March, February. Depending on that, we need to find out what should be the end date or last date of the year. So this is how we can prepare income statement. After preparing the income statement, we need to prepare the owner's equity statement. This is the format we know. We will start with the beginning balance of the capital or owner's equity. We'll see whether there is any additional investment by the owners or not. We'll adjust the net profit or loss that we identified in the income statement. We'll deduct the drawings if there is any, then find out the ending owner's equity. And from the information given to us, is there any beginning owner's equity?
Yes, sir. 88.
Beginning
8800.
balance.
Yeah, this beginning balance 8800 is the beginning equity. And as far as I remember, there is no additional investment. Net profit or loss, we just determined 3130. This is the net profit or loss of the organization. Is there any drawings?
Just sir, what
Yes.
about that bank standard federal bank thing? Won't that be an investment?
If your organization take loan from the bank, will it be an investment?
We are borrowing money to use it for our day-to-day expenses, maybe. So,
Yeah, who is borrowing money? Owner or organization?
oh, the business is borrowing.
Business is borrowing. So it's a business loan, not and in the owner's equity part, we think from owner's perspective. So these two are separated. Is it okay now?
Ji, sir.
Okay. So we are discussing about the withdraw. Is there any withdraw drawings?
Yes, sir, 700.
700. So we'll transfer this information here. This 700. As we already mentioned, we are going to deduct the drawings. That's why we do not need to mention any negative sign here. So this beginning capital will add if there is an additional investment, we'll add the net profit. If there is any loss, we'll deduct it. Then we'll deduct the drawings part. Then we can find out what is the ending capital, which the amount is 11,230. So according to owner's equity statement, the ending balance of the capital or ending balance of owner's equity should be 11,230. Now, if you looked at the tabular analysis, you can also see the tabular analysis also shows that the ending balance of owner's equity is 11,230. That means these two must be same. If these two are not same, you have to consider that you need to think that you made some mistake to transfer information from tabular analysis to uh, owner's equity statement or to the income statement. So this is how we can prepare the owner's equity statement. And finally, we can prepare the balance sheet. In the balance sheet, as you know, we have to show the asset, liability, and owner's equity, and we will just transfer all the assets, liability, and owner's equity from the tabular analysis to the balance sheet. We'll transfer all the assets, cash, accounts receivable, supplies, equipment, all the liabilities, accounts payable, notes payable, and owner's equity with the balances. Which balance? What is been written here? What is the date?
31st August.
31st August. With the 31st August balance. With the 31st August. 31st August balance means this is the ending balance. This ending balance. That's why it has been said that balance sheet is prepared or balance sheet shows the organization financial condition of a specific date. These dates. According to this example, the balance sheet we are going to prepare, that balance sheet will show you the financial position or condition of the organization on August 31st. Now we'll transfer all the assets, liabilities, and equity with their respective balance to the format. Cash assets were sorry, cash, accounts receivable, supplies, equipment, liabilities were accounts payable, notes payable, and owner's equity is the last capital amount on August 1st. So these informations need to be transferred here. Cash, accounts receivable, equipment, supplies. 4,200, 3,800, 500, 8,000.
Sir, only capital under owner's equity.
Under owner's equity, whatever the amounts here, it's considered as a part of the capital. Because this owner's equity becomes the capital claim of the owners at the end. Because that amount has been calculated after adjusting all the expenses, revenues, and drawings. Okay?
Okay, sir.
So cash 4,200, 8,800, supplies probably 500, probably 8,000. Yeah, 3270, 2,000. and capital amount was this one. Sorry. So that's how we transfer all the information. Now we can find out. Yeah. Sorry. This is our this is our total assets, 16,500. This is our total liabilities. We need to show the liabilities separately as well. And this is the total claim of the owners. And after preparing this one, or after doing this one, we also need to write it down like that. Total assets is how much? This is the total asset and total liabilities and owners equity. This sum of and finally we can show that these two, that means total assets and total liabilities and owners equity, are same, because we know that in the balance sheet we need to show the relationship of asset, liability and equity. And total asset must be equal to total liability and owners equity. That's how we can prepare the balance sheet. Have you got some idea?
Sir, I wanted to ask, sir, do we have to do something on the Excels?
It actually depends on, if you are asked to do something or solve some problem in handwritten, then you don't have to. But if you are allowed to do anything in Excel or something like that, you can do it. Okay. Any query up to that?
Sir,
Sir, I think we have to memorize most of the things.
You don't have to memorize anything. You just try to understand. If you can understand, it's a very easy thing. You don't have to memorize anything in accounting. Just to understand what are the process we have followed, how we have followed.
Okay, sir.
Yes, sir. Yashana?
sir, could you explain the format of the income statement again?
In the income statement, what is the objectives of preparing income statement? Can you please, Yashana, what is the objective of preparing income statement?
Sir,
Income statement, what is the objective? To measure the financial performance. To measure the financial performance. And how can we measure the financial performance? By identifying profit or loss. How can we identify the profit and loss? By comparing revenue and expenses. This summary that we have discussed in the first session has been shown here, that we try to find out the financial performance by identifying the net profit or loss, and to find out the net profit or loss, we compare the revenue and expenses of the organization. And this should be the format: name of the company, income statement for the, if it is for a month, month in date; if it is for a year, year in date; and last date of the accounting period will be mentioned here. And we have seen how can I identify the different types of revenues and expenses from the activities that we already have analyzed. Have you got idea?
yes, sir.
Okay. Any other query from any of you? you might have some query, please feel free to ask me. So whatever we have done so far, it is basically a part of the identification of transaction. Whatever we have done so far is basically a part of the identification of transaction. That means if when any activity is incurred in an organization, whether we should consider it as a transaction or not. Now we are going to see what are the steps of accounting or steps should be followed in accounting. First step of accounting is identification of transaction. Second step is after identifying the transaction, we have to record and summarize, recording and summarizing the transactions. And whenever we have to do the recording and summarizing the transactions, there are a couple of steps we need to follow. We need to prepare journal, we need to prepare ledger, we need to prepare file. There are a couple of more steps we will follow later on, but now we are going to concentrate these steps. That means we already have done the first step, identification of transaction. Without identifying the transaction properly, we cannot move to the next steps.
Sir, the whole thing we did, was it just the identification of transaction?
Yes, the whole things we did so far, except this financial statement preparation, was a part of the identification of transaction. Okay. Sorry. Get some water. Was a part of the identification of transaction. Now we have to see how can we move to the next step, that is journalization. So now journal or journalization. Whenever we have to do journal, we have to follow a rules which is known as debit credit rule. Now if you ask me what does the debit means and what does the credit means, I cannot define it because there is no definition of debit and credit. It's just a rules which helps us to record transactions into the journals. Can you remember this one?
Yes, sir.
It is the accounting equation. Can you remember that we have explained this accounting equation like that?
Yes, sir.
Yep, we have explained or we have made an elaborate explanation of the equation like that. Then can I write it down, this equation like that? Can I write it down like that?
Yes, sir.
Just we transfer the negatives one to the left side. That's all. That means in one side we have written asset, expense, drawings. In another side we have written liability, capital and revenue. And the debit credit rule says that we know that this asset, expense and drawings can be increased and be decreased as well. Similarly for the liability, capital and revenue, it can be increased, can be decreased by a transaction. And now let's see what does the debit credit rule says. This debit credit rule says that when asset, expense or drawings increase in an organization, we have to debited, in short, DR. Have to debit it. On the other hand, when asset, expense, and drawing decrease, we have to credit it. On the other hand, for the liability, capital, and revenue, when increase, it's just an opposite of the whatever we have done in the asset, expense, and drawings. When liability, capital, and revenue increase, we have to credit it. And when liability, capital, and revenue decreased, we have to debit it. That's about the debit credit rule. That means it suggests us or help us how should we record different types of accounts in journal through journalization when incurred in an organization. It said that we already know that how to analyze the transaction, how could we identify different types of accounts when there is an asset, expense, and drawings. If it increase debit, if decrease credit. On the other hand, if there is any liability, capital, and revenue, if increase, we should credit it. If decrease, we should debit it. That's how the different types of accounts need to be handled by the debit credit rules. Now let's see how can we do that.
Sir,
Yes, sir.
so sir, if revenue increases, so it's credit, right?
It credit, yeah.
I mean, why is it credit? Why shouldn't it be? I think it should be debit, right?
Uh, why do you think like that?
Because sir, as we are getting much more revenue,
Hmm.
which we can use it
Hmm.
for future purpose, so we
Hmm.
can store it as assets.
So then access a different account. When increase, it should be debit. All right. So just follow these rules. Just follow these rules. We know how to identify different types of account, and we'll follow that analysis to these rules to find out how should we generalize it. Let's see some examples. It will help you to understand more clearly.
So can you please explain like why is revenue credit and expense debit?
There is no explanation for that. There is no definition for that. This is the rules that has been developed. It just said that follow these rules to record your transactions. Okay. There is no definition of debit and what does the debit or what does the credit means. It just a debit credit techniques that is being used for the purpose of recording the transactions. And whenever we will record the transaction, then it will be clear to you why we make a debit and why we make a credit. Now let's there are three transactions are here. You now need to help me to find out for the transaction analysis part, and then we'll see how can we go for recording through journalization. Okay, the first one, James Royals begins business a real estate agent with a cash investment of $17,000. What do you think?
Cash and owner's equity.
Cash and capital, then we'll transfer to the owner's equity. So cash is an
Asset.
asset, a part of owner's changes,
Both are increased.
both increasing. Both are increasing. So now uh, we definitely have to do this analysis before moving to the next step. We have done the analysis. Now apply the debit credit rule here. So cash is an asset. Asset increase. What does the debit credit rule says? If asset increase, it should be debited. In short, DR. Capital owner's equity. If owner's equity increase, it should be capital
Credit.
credited. It should be credited. So our journal here for
So here
this
C means capital.
C means capital. C means capital. So we can record the journals is like that: cash, debit. We'll see the format and other issue in the next session. Just trying to give you some basic idea about the journalization. So capital, credit. So this is how we'll journalize this transaction: cash debit, capital debit, and the amount was dollar 17,000. $17,000. That is basically the journal for first transaction. Second one, hires an administrative assistant. Okay, forget about this. I don't want to. It's not a transaction. Hires an administrative assistant. Is it a transaction?
No, sir.
No, it's not a transaction yet, because this assistant yet not provide any services, and you are not liable to pay them as well. Let me change this one. Who is there's some noise from one of your friends. Aisha, can you please mute? Yeah. Okay. If the transaction is like that, pays the administrative assistant 2,500 salary in October. Cash and salary.
Asset and
Assets and expense.
expense.
Assets and so now cross check it with the debit credit rule. Okay. Increase or decrease? Cash
So decrease.
Decreases.
decrease. Salaries expense
Increase.
increase. Increase. Increase. Now debit credit rule. Cash asset decrease. If asset decrease, credit. If expense increase,
Debit.
debit.
Credit.
Expense
Debit.
increase, debit. Debit. So cash should be credit, salaries should be debit. One thing we should keep in mind: we should record debit first, then the credit. So salaries debit should be recorded first, cash credit, then it will be recorded. So our journal will be for the number 2, salaries or salaries expense, whatever you want to write. Salaries expense debit.
If you write only salary,
It's okay.
will be okay.
It's okay. It's okay. That's what I mentioned, that salaries or salaries payable, whatever you like. But and cash credit 500. That's the journal for transaction
So
number 3.
we should write accounts in the journal, right?
We will. It's better to write down, but you can skip it. Did you mean cash account, salaries account like that?
I mean, there is a part of accounts, and the other one is what kind of account, like assets, capital,
Yeah,
cash?
we can skip that one. Yeah, we can skip that one. We can directly write it down like that. Third one, purchase office furniture 1900 on account.
Cash.
On account.
Sorry.
Mhm.
Account payable.
Accounts payable and furniture. Accounts payable is a
Liability.
liability, furniture is a
Yes.
asset. Changes,
So both are
both are increasing. Now, cross check with the rules. If accounts payable increase, liability increase. If liability increase, it should be
Credit.
credit. Furniture is an asset. If asset increase, it should be debit. We should write the debit first, then the credit. So furniture debit, accounts payable credit. $1900. That's how the initial assessment or screening of journalizations need to be done. Have you got some idea? Okay. It will be clear to you all when we'll solve more problems and we'll discuss more. So that's this is the things we are supposed to cover. The next steps we will focus on this generalization, and we have shown you how to do it. But whatever we want to do, we definitely have to go with the first steps: identification of transaction. This is the identification of transactions part, and then we'll cross check it or match it with the debit credit rules to prepare our journals. So you definitely again, you in the next sessions you have to go through, or you have to try yourself, or you have to practice yourself with a problem that is uh, exercise number 2.8 from your book. That is the exercise number 2.8, this one from your book, 103 page number of your PDF. So what you have to do, the things we have tried to do, that you have to go for this transaction analysis. That means you need to find out activities, accounts, increase or decrease, then apply the debit credit rules. What to do? And in the next session, I'll cross check it with you all. How have you done it? Basically, in these sessions, I solve the I cross check with my solution with you all. But in the next session, I'll collect your one, what you have done, and we'll discuss that, and we'll move to the next steps. That means I'm not going to solve anything in advance to cross check with you all. You have to give me your answers that will be addressed here. Try to find out whether there is any problems or not, and after addressing those issues, we'll move to the next step. So in the next session, you have to come up with the transaction analysis by applying the debit credit rule for the problem number exercise number 2.8. Transaction analysis and application of debit credit rules. Is that okay?
So just have to mention the dividend credit, right?
Yeah, just have to mention the debit and credit. That's all. Just like this one. This one. Up to that.
Sir, can you please mention the work again? I could not understand.
Which one?
Our work or what we're doing.
So this is the exercise number you have to go through. You know that a number of activities or transactions are given here. What you need to do, you have to find out what are the transactions given here, what are the activities are related with that, what types of accounts are these, whether they are increasing or decreasing. Now you need to apply the debit credit rule to find out whether these accounts should be debited or credit or not. That's all.
To our individual sheets, sir.
To your, no, you don't have to submit it to me. You just do it by yourself. I will collect it. I will take your opinion in the next session. You have to tell me from your script to me.
Okay, sir.
Okay.
So can I ask you a question?
Anything.
We left far behind.
No problem. Anything. You can ask me anything.
Sir, is any kinds of resources are assets?
Any kind
What's the
of.
definition?
Okay. What is the definition of asset? Can anyone help us, or can anyone help your friend? How can you define asset?
Assets are the things which help generate more assets.
Okay. Anything else?
Like if you have cash, then you can invest it or do something with it to generate more cash. Something
Yeah.
like
Basically, future benefits. That
yes.
it will give you future benefit. That's the definition you can see. Any resources which will provide future benefits, that will be asset. Any resources which already given you the benefits, that will be categorized as assets. Expense. Any claim of the owners, that will be categorized as a capital part or owner's equity part. Earnings from the regular activities or operations of an organization, that will be considered as a revenue. And if any external party is claiming something from your organization, that will be considered as a liability.
Sir, I think I asked you before that also, but
No problem.
I have to ask you again
No
because
worries. Please
it's
feel free.
really a little confusing for me.
Yeah.
Why isn't revenue an asset?
Because revenue is we firstly we separately categorize the revenue and asset. Secondly, whatever you are earning from the revenue, that can be a part of the asset. That will be a part of the asset. And revenue is something that you earn from the regular activity. So sometimes you may need to find out, so this is the regular operation of the business, and that's why we have started the business, and how much we have earned from the regular operations. To find out that things they that amount, we need a separate account. That's why this revenue account has been created. Now, if you ask me why revenue is not an asset, basically these two are not asset because these two are different things. So you are earning something from your regular operations, whatever you have gained, whatever you have earned from the operations or regular operations, that will be considered as a revenue.
But
How?
sir, it fits the definition of assets, right?
How?
Because I don't know about the sacrifice, but
Forget
it's
about
the
the
resource.
services. Forget about the sacrifice. That's resources.
It's the resources. These are the resources that provides our future benefits, right?
Which one?
We use we do use revenue for our future benefits.
Which
Whenever
which revenue? Can you give me an example?
in any kind of revenue, like what we earn, we use it for future
that
benefits, right?
that that's say for example, say if you looked at any transactions of the revenue, maybe we have discussed in this session as well as the previous session. Here,
Sorry, can I help and answer him?
yeah, please.
So the thing, what I understand is that a company normally does not use all of its revenue to generate more asset. So basically, they categorize, as far as I can understand, that they categorize the revenue. Some part of the revenue they use it for for expansion. The other parts they use it to serve other purposes like shareholders' expense and
Or they draw the
and
money.
so the category which they use to expand the business is the asset, and the is called the asset or cash or bank or whatever you call it, and so that part of the revenue is called the asset, and the other isn't. So am I right, sir?
Partially right, that the full amount is not being used for that, and that amount can be used for different purposes. But if you looked at this, this is the a transaction that perform services 10,000 and maybe receive full cash or not, forget about that one. So whenever this is becomes a transaction perform services of $10,000, huh? So what are the accounts are being identified? One is service revenue, another one is cash or accounts receivable, that amount. Okay, that means whenever we are analyzing the transaction or identifying the transaction, in the very beginning we separated these two accounts. So we have got this amount of cash. What is the sources of cash? Revenue is the cash. From the revenue is the sources. So cash becomes an asset which will be utilized for different purposes. Maybe for the expansion of the business, maybe for buying equipment, maybe for paying the shareholders, or maybe from other purposes. That is the amount of cash, or some other assets have been received. But what is the source of that? What is the source of that? From where we have find it out? According to this transaction, that is the service revenue. Now question is, why we have categorized this as a service revenue? It has been categorized as a service revenue to identify, okay, we have started the business, that should be the main activity of operation of the business. From that operation, how much we have earned, that need to be identified, and this earnings becomes a revenue. You can collect money from different sources. You can borrow money, the owners can invest it, and the regular operation of the business as well. So you need to identify how much cash or some assets you have received from the owners. That will be the capital part, and cash will be an asset, you can utilize it. How much you have borrowed from the bank? So loan from the bank is one account, cash is another account. So you have a liability to the bank and you have cash on hand as an asset. And you have started the business for some operations, and this is your main objective, to do some activities and to earn something. And now you might be interested to know, okay, this is our regular activities. From that activities, how much we have earned, that will be categorized as a revenue. And whatever you have earned, it may be cash, maybe some other assets, you can utilize it for future expansion, to buy something, to pay loan, to pay shareholders. What might be the reasons for that? That's why we have to categorize whatever activities incurred in an organization as an asset, as a liability, as an expense, as a revenue, or as in capital. Got it? Okay. Feel free to ask me. I will try to uh, respond. And also, as your friends have shared, thank you so much. You can share your views as well, so that we can make our discussions more productive. Any other views? Any other query?
Sir,
Yes, sir.
I had actually intended to ask about the format of the owner's equity statement. I ended up asking about income statement instead.
Okay, tell me. What is your query?
Sir,
Yes, sir.
where will
What?
I submit the homework?
You don't have to submit the homework, you just have to do it by yourself. In the next session, I will collect from each of you or ask you one by one that what was your solution, and try to
Okay.
grab it.
Okay.
Okay. Yeshana, sorry.
Sir, I wanted to ask about the format of the owner's equity statement.
In the owner's equity statement, our objective is to find out the claim of the owners and how it is going to change over the time. That's why we have to start with the beginning claim of the owners. That is the beginning claim. And the claim of the owner changes by additional investment by the owner, by the net profit or loss of the organization, as well as if anything is withdrawn by the owner. So that's why we have to add additional investment, we have to add net profit or loss, we have to reduce the withdraw or drawings that has been made by the owners. Then we can find out the what is the remaining claim of the owners that has been shown into the owner's equity statement.
Sir, I want to ask about the quiz.
Let me finish this one. Okay, sir. Is it okay, Ishana?
Yes, sir.
Anything else?
No, sir.
Okay. Sir, what is your query regarding quiz?
Sir, what's the quiz duration, sir? Because sir, I have another quiz at the same time.
When is quiz is going to be start?
So 7 p.m. on 24.
7 p.m. How long the durations?
40 minutes.
40 minutes. So our window will be open at least for 1 hour or more than 1 hour. So, and the duration of the exam may be 20 to 30 minutes maximum. So after completing that one, you can easily attend that.
So, sir, I can start at 8 p.m.
Yeah, you can start at 8 p.m. or depending on how long it may take, what is the duration, based on that you can adjust your time. Okay. Any other query from any of you, sir? Okay, looks okay. Thank you all. Thank you so much. We'll feel free to share your views with me. We'll try to clarify your concept as much as possible, and try to clear yourself from the very beginning, because if you fail to understand something from the beginning, you may face difficulties in the later on. So try to clear the concepts we are going to discuss at this moment, and that will help you to understand the next issues, next topics we are going to discuss, and feel free to share it with me as well. Thank you all. See you in the next session.
Thank you, sir.
Thank
Thank
you.
you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.